Hello and welcome to this mid-month update on the Contango income generator. I'm talking to the portfolio manager in question, Sean Burns. I'm Peter Switzer, of course. And Sean, how's the fund going?
Well, I think it's doing okay. I mean, this is a tough time for yield funds with what's happening in interest rates, and also what's happening in the Royal Commission is reverberating through a lot of the sectors that we invest in. So I think that, you know, I'll be glad when that is all behind us and we can assess exactly what's happened, but it has been a challenging 6 months.
Well, Sean, some people, you know, watching and listening to this would say, but hang on, Sean's fund doesn't really invest in the big banks. You're sort of outside the top 30. What kind of companies are being affected then?
Well, the wealth managers, so we own a fair few of those. But also when you think about the regulations going on through Australia at the moment, I mean, gas has been looked at, electricity has been looked at, telcos, gaming.
It's disruption everywhere, isn't it?
That's how it's manifested itself. And it's probably no surprise when you look at the best returns have been in those companies outward facing, you know, like the foreign earners and the resource companies have done best over that period. I think we will work our way through that, though it is a tough time at the moment.
Well, for, I guess, vested interest purposes, because as you know, I have a strong association with the Switzer Dividend Growth Fund, which of course you have a strong involvement with as well. I'm seeing a lot of these sorts of companies as being probably a good contrarian play, only on the basis that they are inherently safe companies that are being forced to cope with a whole lot of headwinds at the moment, and understandably the market is marking them down. But their businesses per se have not been terribly undermined. They might have to change, they might lose some basis of profit, but I don't think the banks are going to disappear.
No, I think that's right, Peter. I mean, one of the things we measure when we look at income generators, how our dividends have increased, 6 months on increase, shares in the portfolio, and they've been consistent through that time, consistent sort of single-digit increases, percentage increases. But the share prices of any bad news the reaction has been like quite harsh and severe at times. So what do we how do we handle that? You know, the companies we invest in are those with strong balance sheets, very important. They give management time to work through these issues. You don't want them having high debt as a millstone around them through that, and that's the companies we invest in. And I think the underlying franchises largely look intact from what we can see. Balance sheets are good, cash is good. They've got to work through this period.
And so in many ways, is it, because you've been in the market a long time, and sometimes your investment time horizon is a lot longer, I would presume, than the people who determine the share price on a daily basis. You know, there's a whole lot of people determining the share price.
That's
of
right.
course, a long-term investor who gets cheesed off with a company can be a part of the self, but it is the more short-term traders that have the biggest impact on daily share prices.
Yeah, I think that's part of being a professional portfolio manager, to be able to say, well, what's in the price? Is this overreaction? Let's have a look at the real issues. Look for the balance sheet. Look at the cash. What are they doing to? Is this a really big problem or a short-term problem? What will they look like getting outside of that? Have they got time, the balance sheet, to allow themselves to get out of this? And what will they look like getting out the other side? So I think that it is quite disconcerting to see the share price volatility, but we keep looking at the cash and the balance sheet and the management quality, the underlying franchise, and say what's the real issues in this. Let's put the share price aside for a while and just have a look to see what's really happening.
Now our market's been up about 6 weeks in a row, not by much, but it's still on a rising trend. Is that giving you heart, or do you think we're still vulnerable to things like, you know, Donald Trump tweets and trade talk and all that sort of stuff?
Yeah, the market is recovering. I think that, as you know, Peter, goes from optimistic to pessimistic. There is a optimistic skew. We don't know how long that'll run for, but I think that's long may it last. From CIE's point of view, we follow the same strategy regardless, and we are long-term investors, and we're looking for those companies that can throw off good, strong dividends.
Okay. Looking at CIE, what kind of yields does it historically pay, and what's the franking situation?
The board has a policy of paying 6.5% of NTA. That's yearly NTA after tax. That gets set the 30th of June, so that's coming up soon. Franking has been running around 50%. We made an important announcement last week where we're reducing our level of cash in the portfolio and putting that into the existing portfolio largely. That will increase the level of franking, hopefully into the 60s. So that's the strategy.
And some people will be saying, well, why don't they chase 100% franking? What's the reason for not doing that?
It's the balance in the portfolio. I think that usually fully franked shares, what you're not investing in there is utilities and property trusts. They're the unfranked portion, and also some foreign companies like New Zealand companies, which are good payers. The stability that gives in REITs and utilities and infrastructure it gives a good blend of the diversification benefit of the portfolio. They're very stable companies. The ones that are fully franked are probably a bit more riskier, so we balance that up given that they don't have franking. Okay,
to finish up, what are some of the challenges for the portfolio moving forward?
I think that seeing what happens at the Royal Commission, if there are any, we're interested in any ongoing business issues. Are the franchises being undermined? Will they have to adjust? Is there anything going to happen long term to those franchises? We have to make those decisions. Also, interest rates, how will they go up? There's not much we can do about that. I suppose we're a bit more cautious on those more exposed to that as interest rates go up. We think interest rates
in the US or here?
Well, I think ultimately it's the US that we're more worried about, and that impacts our market. So we're being cautious on those two fronts, but I think the Royal Commission will end. We'll see what comes out of it and see any opportunities that come out of that.
Okay, Sean, thanks for joining us, and let's hope the market heads in the right direction.
Thank you. Thanks a lot, Peter. It's been a pleasure.
That's Sean Burns, who's the Portfolio Manager at the Contango Income Generator Fund. I'm Peter Switzer. Thanks for joining us.